Here today, I also want to talk about my top tip for raising finance when you are currently tied in. It does get me frustrated on a regular basis where I'm talking to my clients who think, well, I'm tied into a mortgage for another, let's say, year. My fixed deal doesn't end until April 2024. Therefore, I cannot get out of that deal. I cannot access my equity. Now, that's fine if you're in no hurry, if things are just ticking over and you're happy to wait another year. But what if? What if you've got that deal of the century that's just come on your table? You've got the opportunity to buy a property at a significant discount, or you've got an opportunity to buy a property where the rate of return or the yield is exceptionally high, and you really, really don't want to miss out. But you're tied in. You don't have the savings to put down as deposit. You need to access that equity to be able to buy this property. What are you going to do? Well, you can't wait, can you? So here's some options. The blindingly obvious one, well, is it worth paying the redemption penalty? Yes, you can. You look at your terms of your mortgage offer, you might be surprised. The penalty might be lower than you think. It's not unusual. Let's, for example, take a 5-year fixed rate. It's not unusual for those penalties to reduce year on year. So if you happen to be in year 4 or indeed year 5 of your 5-year fixed deal, those penalties could be quite modest. Could be a pleasant-ish surprise. But you have to, either way, I would really challenge you to say, look, don't just think of the penalty and that, oh, I'm paying £1,000, I'm paying £2,000 as a penalty. And in principle, I refuse to do that because why should I pay the banks that money? That could be cutting your nose off here to spite your face. Look at it in context, of course, of what that discount is that you're getting. Or if you think it is an exceptionally high yield, an exceptionally high return on investment, then look at it in context of the additional benefit you're going to be getting. And if it's going to cost you £2,000 to get out of your penalty, but you're going to get an extra 5 or 10 or 20 grand discount on the purchase, or year on year, that additional yield you're going to be putting in your pocket means that that will offset that penalty, then why wouldn't you do it? That's the first thing. But there might be some cheaper options for you. The next one is further advances. Again, there'll be some people I'm talking to today that have never come across a further advance for whatever reason. So let me explain what that is. So this is like a mini mortgage, and it sits alongside but independent to your main mortgage. And you approach your existing bank or lender to apply for a further advance. Now, not every lender offers that facility, but I would say the vast majority do. So there's a good chance that your lender will have this facility. But as I said, you have to apply. It's not a gimme. You have to jump through hoops. There will be credit checks. You will have to show income and outgoing information. There will be assessments of what the rent is and whether that will service the extra borrowing that you're looking for. So yeah, there's lots of hoops to jump through. But if you jump through those hoops successfully, I can tell you that it's highly likely that that's where the lowest cost of extra borrowing will be in a further advance. In all the things that I'm talking about here, that's the one that's likely to be the most cost effective for you. You can either do this yourself or, again, as brokers, it's something that we do all the time, so we can look into whether you might be eligible for that. Now, what if that your lender doesn't offer further advances? What if, yes, they do, but they're not going to give you the extra borrowing you want, so you don't have enough for that deposit for that next purchase? What are you going to do? Well, you can then move on to something called a second charge. Now, again, this is very similar to a further advance, but instead of approaching your existing lender for this mini extra mortgage, you're approaching an independent lender for that extra borrowing. Now, as the name second charge more than suggests, let me just talk about main mortgages. They're classed as a first charge. So a second charge, as the name suggests, sits behind a first charge. So it's seen as a higher risk to these lenders where they're offering second charges, because if the worst happens and there's a repossession and everybody wants their money back, then your main provider, your main lender that has the first charge, has first dibs once that property is sold at reimbursing themselves what they're owed. and only if there's funds left over does the second charge lender then get a chance at reimbursing themselves. And that's why it's seen as a higher risk, and therefore the interest rates are highly likely to be higher with a second charge lender, but still might be competitive, still might mean that it makes financial sense for you to take a second charge loan because, as I said earlier, the discount or indeed the return, that investment outweighs the cost of borrowing. So again, speak to your broker about second charge options. The last one, probably the least known, and I suspect will take most people out of their comfort zones because it's unusual, essentially to approach a private individual, usually, to work on a joint venture basis. Now, before you jump to the misunderstanding of what I mean by joint venture, because under that broad definition, there is actually a number of permutations of what a joint venture might mean. Now, I am not meaning going into a 50-50 partnership with someone, which means you're giving away half the equity, half the profits of this next purchase that you're going to do. I'm talking about a far more simplified approach and something that's called the guaranteed interest model. And that's simply borrowing money from an investor, and you're going to pay them a return in interest on the amount that you've borrowed. It's a simple loan. So trust me that this happens on quite a regular basis. You just need to understand how it works and know how and who to approach who might be interested in investing in you. If they're earning 1-2% on their funds in a savings account and you could offer them double or treble that as a return, then wouldn't that be a win-win for everybody? It could also be done on a second charge basis, so that investor might put a charge secured against your property or properties, so there's an extra comfort blanket for that investor. So that's something you might be able to offer as well. But what I want to just get across this morning is the number of options that are available when you're wanting to raise finance, when you're tied in. Don't naively think that you've just got to wait until your deal ends before you can access that equity. So if any of that is of use to you, if you want to explore that a little bit more, get into the detail of that, whether that's something that might be useful for you, then please get in touch, book onto the online diary system, have a chat with the team, and let's see if we can help.